Hey, what's up everyone? Sam with the Humble Outliers. Today's video is on 5 investing hacks from the great Warren Buffett, also known as the Oracle of Omaha, one of the GOATs of all time when it comes to value investing. So we're going to go over 5 things that we can all learn, and that's going to help us be better investors for a lifetime. These are 5 ways to invest like Warren Buffett today. But before we start, please smash that like button down below and subscribe if you haven't already. It's always hard for the little guys, so any support you can show, I greatly appreciate it. But before we start, I'll just go over and quickly show you my M1 Finance portfolio as well. The market's doing really well lately. I've recovered most of my losses since that downturn from the Rona. You can see here that mostly it's been coming from the tech cloud sector that I've got going in here. The airline sector is down quite a bit, as you all know. Property REITs are down. Financials are down. The tech cloud's done really well for me. Going in here, looking at the fractional share side of it, biggest performers have been Shopify, Amazon, Nvidia, Tesla, and also the consumer spending sector has done really well for me too. You can see that Netflix has done well as Target. A lot of those retail stocks have done really well as well. All right, so the first tip from the great Warren Buffett is to buy the business, not just the stock or the digital trade confirmation. Something that Buffett always talks about is when we're looking at a stock, think of it as if you were going to buy that company and what you would get out of it. He uses the analogy a lot of, buying a farm and what that farm will entail. What type of products that farm will produce, what type of cash flow that farm will generate from what the produce that it makes, and as well as all of the costs and the liabilities that go along with having that farm, the costs associated to run that business, as well as to produce those the cost of goods. So when you think of this as another way to look at it, especially with these REIT stocks, like O is another example. So with real estate stocks, as you know, when you're buying those stocks and those businesses, you're buying all the assets that come along with it. And with REITs, they're down quite a bit because of the Rona, and with customers not going in, businesses not operational yet. As states start to slowly open up, those businesses will start to generate the revenue. So when you're buying stocks currently at the prices that they're currently at, the PE ratios that they're currently at, think of what you're buying with that business, along with it, what type of obstacles and what type of successes that will follow with it, and also looking at the company's fundamentals, as you know, is looking at the cash flow as well as the debts that it has, and then also looking at it from a business perspective, what kind of challenges that business will face, and of whether you want to be a part of that ride, and whether if that price that business is currently being purchased at, the PE ratio, if it's going to make sense to your long-term goals. And investing hack number 2 from the great Warren Buffett is look for companies with a strong competitive moat, one that has the secret sauce to fend off competition. Let's look at Apple as an example of this analogy. As you all know, Apple is one of the biggest companies in the world, has a market cap of 1.3 trillion, and it's currently priced at 303. This company is huge, but if you looked at the company's trajectory before it got to this point, you would know that this company has had a really strong moat, and they've done a good job of building that moat as well. They've expanded from just a device company to now selling, services of the Apple TV service. Their App Store has always been really strong. They've done things to the Apple Watch, the Mac laptops. They're always looking to expand their product line. What's nice about Apple as a whole is that it has really strong customer loyalty. I know in particular for me, I'm a big Apple user. I've tried going to Android, and just for whatever reason, I just can't stick with it. And I just love the simplicity of Apple. So I'm definitely a long-time Apple user, and someone who's slowly over time just gotten more and more of their products and just got more deeper into their ecosystem. I recently purchased a laptop. I love that as well. But with Apple, there's this huge moat. They've got a lot of cash. They can always disperse and research new products. And then with that, they can be very competitive in regards to, looking for other options, other services out there to offer their customers as they're expanding their TV stream services, their Apple TV devices. Their ecosystem is getting much and much bigger. And then with that, it's going to be harder for customers to switch. As I was talking about an example of myself, by their competitive mode is really having an ecosystem that it's hard for somebody to switch. So that's something that you should look for, according to Warren Buffett. This is one of his biggest holdings, Apple is. Another company you can think of is, Amazon. With them being one of the biggest players for e-commerce, being able to buy items and purchase just about anything you'd want and have it delivered within 1 or 2 days. I mean, that's a huge competitive moat for them. I typically always buy a lot of things from them just because it's easy. You don't have to create new accounts. And the fact that they've got awesome service, customer service, consistent delivery, fast delivery, that as a whole just makes them really strong and competitive. And that's another thing that you should really look for when picking stocks for the long term, according to the great Warren Buffett. And hack number 3 is focus on the long-term intrinsic value of that company, not just the short-term earnings. Focus on companies that can generate large amounts of cash and free cash flow, ones that can consistently grow over time by the cash they generate. If you look at a company like Apple, again, as an example, you can see that their profit margins are at 21%, but also the cash on hand, look at their balance sheet, $94 billion, and as well as the cash flow that they generate is $45 billion. So looking at this, you can know that this company is going to be able to sustain any type of obstacles that the market can show it, as well as have the cash to research and grow their business and grow their moat and protect those assets. They might not always have the newest or most innovative products, but they don't necessarily have to. They just have to bring products and services that their loyal customer base already wants, and then that they're going to be able to give them something consistent quality as well with that. You can see that with Apple, they consistently always hit their earnings. As you can see that Apple usually always consistently hits their earnings. They're very consistent in that. And it's because of the way that their CEO is running their business. They do a lot of things to help improve the equity of the stockholders, which cash buybacks. Another company that fits this mold is Microsoft Corporation. I got into this stock about a year ago, and it's been really just positive, awesome earnings ever since. Great capital appreciation. They pay good dividends. This company, as you know, has a really strong balance sheet as well. They got a $137 billion in cash. They generate $36 billion in cash flow. You can see here also that their profit margin's pretty heavy too at 33%. What I like about Microsoft in regards to this same type of looking at long-term value is that they've got 3 different sectors of their business that's doing really strong. Each of them holds their own weight, whether it's their cloud business, which is catching up or slowly taking share away from Amazon Web Services, or their software solutions, which is Microsoft Teams. With how the Rona's going around, a lot of companies are using Microsoft Teams for virtual business services, and then as well as their suite of products. And then also their hardware business is also huge too, whether it's their computers or their Xbox that's going to be coming out pretty soon. They've got a lot of different options for their customers, and their moat is just huge in regards to sustaining different market challenges. If one sector was down of that, trifecta business that they've got going, then another can, pick up the slack. So I would say Microsoft is another one of these stocks that for the long-term intrinsic value, you can always just ignore the short-term earnings because the cash flow they're going to be producing is going to help sustain this company long-term. And investing tip number 4 is look for value. Warren Buffett's a big value investor. He's looking at the businesses and buying businesses at the cheap. He looks at PE ratio. He looks at the fundamentals. He looks at the financial charts of the business. And what he's looking for is to buy a business that's going to be at a cheap margin where a company has still a lot of cash flow, where it can generate and sustain that over the long term. And that's going to give, the investor a lot of, whether it's cash flow from dividends or depreciation or appreciation over time. You can think of companies that can, sustain what's going on with the markets and things that are just unforeseeable, like the Rona right now. Companies like Wells Fargo, I know they're although they're being, hit really hard right now and they're down big over the year, this company is at a relatively low PE ratio at 8.73. So this is something that would fit into the mold of what Warren Buffett would do. And the fact that this company, if you looked at it, they do have a lot of cash on hand in their balance sheet at $356 billion. And although they've missed their earnings, that has not stopped Warren Buffett before. Like we were talking about, he doesn't look for the short-term earnings. He's looking for the long-term potential of this company. And whether if he's buying at a low PE ratio, he wants to see companies that can sustain this with their cash flow and over time, regain those lost, whether if it's that price depreciation that's lost over time or having it give a chance to go back and gain appreciation again. Another analogy would be looking at Southwest Airlines, ticker symbol LUV. As you know, this stock right now is getting hit really hard with what's going on with airlines being really slow. 95% of the revenue is down, but the PE ratio is at 7.40. And this fits into, even though Warren Buffett sold out, if you looked at it from the same analogy that he was speaking of, you're buying this company right at a huge discount because of what's going on with the market. So this kind of fits into what he was talking about when you're looking at a company, whether he sold out of this or not for his own reasons. This should give you the the insight of thinking about, okay, so if this company's down, can they recover? What about their debts on hand? What about the cashes that they have on hand? And this is also a stock that I'm currently looking at as well. As far as balance sheet goes, they've got $5 billion cash on hand, $1 billion cash flow. Whether that's down right now, but looking at the long-term perspective, I think if you're trying to think like Warren Buffett, looking at stocks as a whole, at the the cheaper end when you're purchasing them, you have to put these things in your own consideration. His strategy is different than all of ours, but you just have to still use those same type of principles when you're evaluating stocks yourself. And the last tip from Warren Buffett is to keep calm and be patient. Being patient is such a huge, important thing when it comes to investing. Our emotions take over, volatility, chatter from what's going on in the media, all these type of things, friends telling you about stocks, all these things take effect and, they start to impact your decision making in regards to picking stock and buying stocks, selling out quickly. The key to Warren Buffett's success has always been the focus on the long-term gains. He's a big proponent of the value investing approach. He's not necessarily someone looking for, the day trading approach or the short-term gains approach. He's all about looking at it from the perspective of when you're buying a business, you're holding it for the long term and you're being patient for those gains. With that, it takes a lot of, temperament and also, just resiliency to know that when you're going in and buying these stocks. That's why it's, always not helpful when you're looking at the stocks daily. Right now, working from home, I'm looking at the stocks daily, so it eats at you. But being really disciplined in your investing approach and being patient, making sure you're doing your due research before you're picking and buying your stocks, so that when you're going in, you feel comfortable holding that stock for years. I have stocks that I consider my buy and hold forever stocks. I'm sure you do too. And these stocks are ones that I can buy at any point and feel comfortable holding them for the long term, whether it's for dividends or whether it's for, you still see long-term upside in regards to the appreciation of that stock. These are all things that you've got to be comfortable with and stay the course with your investing. And that'll wrap up the video, guys. So what do you think about these 5 investing hacks from the great Warren Buffett? Are these, approaches or principles that you currently use? Are there areas that you could do better at? Let me know in the comments sections down below. Don't forget to hit the subscribe button and smash the like button if you haven't already. Thanks again for showing your support and for watching the video. Take care, guys, and have a good one. I'll talk to you guys soon.